Right now, retirees across Australia are giving away tens of thousands of dollars to help their children with a house deposit, a wedding, or simply to make life a little easier for the grandkids. Thoughtful. It comes from a place of pure love. But Centrelink has a rule that follows that money for a full 5 years after you've given it away, and financial advisors are warning that more people than ever are getting caught out by it without even realizing until their pension payment quietly drops. Welcome back to Centrelink Pension Bulletin. Curious, today we're talking about one of the most misunderstood rules in the entire age pension system. The gifting rules, sometimes called the deprivation rules. If you've ever thought about helping a child or grandchild financially, or if you've already done so, this video is one you genuinely need to watch carefully because the mistakes here are common and they can be costly. Let's start with why this rule exists in the first place, because understanding the reasoning makes the whole thing much easier to remember. Centrelink knows that some people might be tempted to give away their savings to relatives purely to bring their own assets down and qualify for a bigger pension. So, to stop that from happening, they created what's called the deprivation rule. In plain terms, if you give away more than a certain amount, Centrelink continues to treat that money as if you still own it for 5 years, even though it's long gone from your bank account. Here's the part that catches so many people by surprise. This isn't just about large, obvious gifts like handing over a house. It applies to everyday generosity too, and the threshold is lower than most people expect. So, what exactly are the limits? Let's break it down clearly, because this is the heart of the whole rule. You're allowed to gift up to $10,000 in a single financial year without it affecting your pension at all. That's straightforward enough. But there's a second layer to this rule that trips up even careful, well-organized retirees. Over a rolling 5-year period, the total amount you gift cannot exceed $30,000. And here's the key detail. These two limits work together, not separately. Even if you stay under $30,000 across 5 years, if you give away more than $10,000 in any single year, the excess above that $10,000 still counts as a deprived asset. Let me give you a very real example, because this is where the confusion usually happens. Imagine a retired woman named Carol wants to help her son buy his first home. She decides to gift him $20,000 in one go, thinking, that's well under the $30,000 limit, so I should be fine. But that assumption is incorrect, and it's one of the most common mistakes we see, because Carol gave $20,000 in a single financial year, and the annual cap is $10,000. The extra $10,000 becomes what Centrelink calls a deprived asset. For the next 5 years, Centrelink will continue to count that $10,000 as though Carol still has it sitting in her bank account, even though it's now sitting in her son's mortgage offset account, completely out of her hands. This affects her in two ways at once. It counts toward her assets test, and Centrelink also applies deeming to it, meaning they assume it's earning her income even though it clearly isn't. Both of these can quietly reduce her pension payment for the full 5 years, regardless of the fact that she no longer has access to that money. Now, here's a question worth sitting with for a moment. If Carol had simply spread that same $20,000 across 2 separate financial years instead, $10,000 in one year and $10,000 in the next, would she have avoided the problem entirely? Yes, she would have. Timing, it turns out, matters just as much as the amount itself. Let's look at another situation, because this is one that catches out couples especially often. Many people assume that because there are two of them, they each get their own $10,000 allowance, giving a combined limit of $20,000 a year. This is a very understandable assumption, but it's wrong, and it's an expensive mistake to make. The gifting limits are combined for couples, not doubled. Whether it's a single person or a couple gifting money, the limit remains $10,000 per financial year and $30,000 over 5 years for the household as a whole. If a couple each gift $10,000 to their daughter in the same year, thinking they're both using their own separate allowance, they've actually gifted $20,000 combined, and $10,000 of that becomes an assessable deprived asset straight away. This is exactly the kind of misunderstanding that financial advisors have been warning about recently. Just this year, one senior technical advisor from a major wealth management firm publicly noted that more retirees than ever are unintentionally triggering these deprivation rules, often because of informal family arrangements or simply not realizing the couple's limit isn't doubled. Now, let's talk about how far back this rule actually reaches, because this surprises a lot of people too. The 5-year assessment doesn't only apply to gifts made after you start receiving the pension. Centrelink looks backward as well. If you gift an amount above the allowable limits in the 5 years before you even apply for the age pension, that gift can still be assessed when your application is reviewed. Here's an example to bring that to life. Suppose someone gifts a holiday property worth a substantial amount to their children at the age of 61, well before applying for the pension. If they then apply for the age pension at 67, that gift falls outside the 5-year window, and by that point it's no longer assessed. But if that same gift had been made at 64 instead, there would still be 2 years remaining on the 5-year clock when they turn 67, and it would still be counted. This is why timing matters so much, and why it's genuinely worth thinking ahead, sometimes years ahead, if a significant gift is being planned. Let's pause here for a moment, because there's an important question worth asking yourself. If you've already gifted money to family in the past 5 years, do you know whether it falls within the allowable limits, or whether it's currently sitting as a deprived asset on your Centrelink file without you even realizing? It's worth checking, because it directly affects the payment you're receiving right now. Now, here's something that catches people out just as often as the gifting limits themselves, and it's easy to overlook. You are required to report any gift to Centrelink within 14 days, even if the amount is well within the allowable limits. It's not enough to simply stay under the threshold quietly. Centrelink needs to know, and it needs to be recorded properly in your file. Why does this matter so much? Because Centrelink cross-checks bank account movements, and a sudden, unexplained drop in your savings can raise questions during a routine review. If a gift was made and properly reported, it's simply on record and there's nothing to untangle. If it wasn't reported, it can look like an unexplained discrepancy, and that's exactly the kind of thing that triggers a closer look into your file. Let's also touch on something that isn't just about cash, because this rule is broader than many people assume. Gifting rules don't only apply to money handed over directly. They can apply to property transfers, to forgiving a loan you'd previously given to a family member, or even to selling something like a car or a piece of land for well below its actual market value. If you're not receiving fair value in return for something you give up, Centrelink can treat that as a gift, and the same deprivation rules can apply. This is particularly relevant for anyone considering a granny flat arrangement with an adult child, where a parent might contribute funds toward a property in exchange for the right to live there. These arrangements have their own specific set of rules, and if the arrangement changes or ends earlier than expected, it can be reviewed and reassessed. If this applies to your situation, it's well worth a proper conversation with Centrelink's financial information service before any money changes hands. So, given everything we've covered, what's the sensible way to approach gifting if you'd still like to help your family financially without unintentionally reducing your own pension? The most straightforward approach is simply pacing your gifts. rather than giving one large lump sum, spreading gifts across multiple financial years, staying within the $10,000 annual limit each time keeps you within the rules entirely. If you're part of a couple, remember that this limit is shared between you both, not doubled, so plan accordingly. If a larger gift is genuinely necessary, perhaps to help with a house deposit that can't practically be split over several years, it's worth having a proper conversation with a financial advisor or Centrelink's financial information service beforehand. They can walk through exactly how the deprivation rule would apply to your specific situation and help you understand the real impact on your pension before you commit to anything.
And whatever you decide, always report the gift to Centrelink within that 14-day window, even when you're confident it falls within the allowable limits. It costs you nothing to report it, and it protects you from any confusion or unnecessary review later on. Here's the bigger picture I want to leave you with today. Helping your children or grandchildren financially is a wonderful thing to be able to do, and there's nothing wrong with wanting to support your family. The gifting rules aren't designed to stop you from being generous. They're simply designed to make sure that generosity is planned properly, so it doesn't come at the cost of your own financial security in retirement. A little bit of planning, spreading gifts sensibly across financial years, understanding that couples share the same limit, and reporting everything promptly can mean the difference between helping your family and accidentally reducing your own pension for the next 5 years. If this video helped clear up something you'd been wondering about, please give it a thumbs up. It truly helps this channel reach more retirees who are trying to navigate these rules honestly and confidently. And if you haven't subscribed yet, join Centrelink Pension Bulletin, because we bring you these updates in plain, simple language exactly as they happen. I'd love to know in the comments below, have you ever gifted money to family and wondered afterward whether it might affect your pension? Or do you have a gifting question you'd like us to cover in more detail? Let me know, and it might just become our next video. Speaking of which, in our next video, we're going to look closely at granny flat arrangements and exactly how Centrelink assesses them, because this is an area where families are increasingly getting tripped up without realizing it. I hope you'll join me for that one too. Thank you so much for watching, and take good care of yourselves and your loved ones.